In this video, we'll talk about how we're adapting to this new volatility regime that we're currently in. Volatility has spiked through the roof. Our old volatility models during that first week when this change happened were almost useless that first 4 days. But then we released our new Doomsday Volatility Box models, which were also updated this past Sunday. In today's video, we'll talk about the trades that have now come out of our Doomsday Volatility Box, which does a much better job of adapting to this new market volatility and giving us an edge at the edge, giving us levels that we can use to start to trade against and really incorporate them into our trading. So from today's activity in the marketplace, we had 4 trades that set up. If we're focusing just on the indice markets, those were in the S&P futures, the Nasdaq futures, the Dow futures, and the Russell futures. Right. So one trade set up across all of them. The Nasdaq was the loser out of the bunch, where we had a 0% winning rate, so that one trade didn't work out. But all of our other trades did work out, and that was really nice to see, especially during this kind of a movement. On each of these trades, we were on our Doomsday aggressive boxes, which also helped us contain our risk a little bit more compared to the Doomsday conservative. So typically on the conservative, we see a risk on the S&P of right around 29 to 30 points. And on the aggressive, we were seeing 13 points. So this trade was a bit more manageable from that perspective. Now, all of these trades hit only their first target, besides obviously the NASDAQ, but then stopped out of our second contract, right? So on the next slide, we'll show you why this isn't all rainbows and sunshine, but using just our P&L numbers for today, that was a positive 650 in the S&P futures off of just one contract. So again, big reward, but also big risk, right? That's the amount of risk that you're taking on the opposite side. The Dow was a positive 550. The Russell was a little bit more manageable with positive 325 for an overall P&L day of 925. And for those of you that use the volatility box, you know that these numbers aren't particularly impressive for us, especially considering that we get to these sorts of P&L numbers even during our normal non-volatility periods. But this is a way that we can participate now, start to get involved in the markets, find out these edges, and really take small nibbles. So our risk is much lower than what I think most other folks have had to take on as risk in this futures marketplace, right? Our risk is contained if you're looking at it on a relative basis, especially when the S&P is moving 3% plus. You need to now adapt to that new volatility. So on this next slide, we'll talk about why this isn't all rainbows and sunshine. For that 925, you had to risk a total of $4,250 to get there. And I think that's the part of this picture that most folks forget to talk about, which is how much did you have to risk? How much were you willing to lose in order to make this amount in this current volatility conditions? However, if you were to try and participate, this is a way that you can start to pull some money out of the markets. Also, these numbers are a little skewed, right? Because if we had the opposite side where we hit both our T1 and our T2, this number would be significantly greater than our 4,250 that we had risked, giving you a really nice almost 2, maybe even 2.5 to 3.1 reward to risk ratio, which starts to make these trades really make sense. So on a day in which you hit just your first contract, it's a good trade, it's a nice day. But on the days in which we get the follow through, whenever that does come, we can't predict it, that's when these numbers will really switch in our favor and really start to give us a nice risk reward ratio. Now let's look at the charts real quick to talk about each of those trade setups. So that came into place on our Doomsday Aggressive box when price fell into our volatility box lines. We had an entry to go long the S&P as price fell into our cyan entry lines. Stop outside of the volatility box. We ended up hitting our target of 13 points in this move up higher, and you had that edge signal populate a little bit later, giving you an even nicer entry than the cyan line if you waited for that. In the case of the Nasdaq, you had an entry once again as price fell into our cyan entry line. Our stop was outside of the volatility box. We gave it 30 points of room, and in this case, we came close to hitting our stop out, but that little buffer room that we always give helped keep us in the trade in the Nasdaq this time around. Again, if you're waiting for the edge signals, which is that oversold, overbought indicator, then you have an opportunity to enter on this move back up, which also hit its target. You went up quite a bit higher on each of these trades, right? In the case of the Nasdaq, you went up to almost 58, 60 points, and that was from our original risk of 30 points. Our target line was closer to the other side in which we were looking for a 105 point follow through in the Nasdaq. Now that is really wild to say out loud, but following the rules of our system, that's where our T2 line is with the break even stop. So it only takes 1 or 2 of those follow throughs to really start to give you a really nice risk reward ratio, as we talked about earlier. Now in the case of the Dow, our entry once again was when price fell into our volatility box. Stop was outside of the volatility box, gave it 110 points of room, and we had that same follow through on the opposite side and a little bit more. And the Russell was our most contained out of the bunch, in which the Russell gave us an entry. Then we also had 3 edge arrow signals populate, while still giving you an opportunity to enter at that cyan line or better. Our risk on the Russell was 6.5 points, and we saw that follow through almost up to 11 points, right? So this gives you an idea of you are getting more follow through than what we're willing to risk. It's just if you're looking for that T2 line on the opposite side, which is what we are, then you're not seeing that follow through that we typically see more often than not. And so knowing that if you're looking to trail your second contract a little bit more aggressively on some of these trades, that also starts to make sense and adds up with what our volatility box models are currently suggesting. So hopefully this video helps you understand not only today's volatility box trades, but also how we're able to adapt to this new volatility movement that we're seeing in the marketplace and use our Doomsday Volatility Box to still take out profits from the marketplace consistently. All right, take care everyone, and we'll see you in the next update.